As an entrepreneur and self-employed individual myself, my income, let's say, fluctuates. And if there's one thing that lenders do not like to see, that is a fluctuating income. So in order to fund my real estate investments, I have to look at different methods to use in order to build wealth in real estate. Many of you know my channel already because of my videos on using a home equity line of credit in order to build wealth. But I always tell you guys that HELOC should not be used long-term. But what do you do if you're looking at a long-term rental investment, but you're a self-employed individual like myself who may or may not show the income required to qualify for that loan? In this video, I'm going to share with you a real estate loan that you could obtain on long-term rental properties without showing any proof of income. Let's get to it. What is up, everybody? Welcome back to the channel. If you didn't already know, my name's Jay Costa, and I'm a real estate investor, agent, and builder here in Northern New Jersey. And if you get value out of this video, please do me a favor and smash that like button down below. It truly helps me grow the channel. We're getting close to 3,000 subscribers, and I truly appreciate every single one of you guys. And on this channel, we go over how to build wealth in real estate. More specifically, a lot of the time, we talk about using a home equity line of credit in order to build wealth in real estate. And we're building a close-knit community here of like-minded individuals looking to build wealth. So if this interests you, please consider subscribing down below as well, and definitely check out some of my previous videos on that topic. But a HELOC is not for every situation. HELOCs really, I always say, should only really be used for short-term real estate investment. But what about long-term real estate investment? Obviously, the 30-year fixed rate loan is the perfect long-term real estate loan to use. But what if you're a self-employed individual like myself who may or may not show the income needed? Well, that's what we're going to talk about today, and this is what's called the DSCR loan. Debt Service Coverage Ratio Loan. In this video, I'm going to go over what a DSCR loan is, what the requirements are to be approved for a DSCR loan, what the pros and the cons are of this loan, as well as whether or not you should be using the DSCR on your next real estate investment. So what is a DSCR loan? Well, like I said, DSCR stands for Debt Service Coverage Ratio, which sounds like a bunch of gobbledygook, but I'm going to go over exactly what that means. And this loan is essentially a loan that bases the qualification on the property, the subject property itself, and not the individual who's applying for the property. And they use the income and the cash flow of the property in order for you to qualify for the loan. So the requirements of a DSCR loan is first and foremost, no requirement at all for proof of income. That means they don't need a W-2, they don't need a tax return, pay stubs, they don't need any proof of income. But this is not a no-doc loan. You do need to provide some certain things. You will have to show 2 months worth of bank statements. This is because the lender wants to make sure they have money to pay for the down payment, the closing costs, as well as 6 months worth of expenses after you close on the property. And depending on the lender, you can show a HELOC balance showing the lender that you have access to equity in your own home in order to cover the expenses of the subject property. Like I said, they just want to make sure that in a worst case scenario, if the place is sitting empty, that you can cover the expenses. Now, there are down payment requirements for a DSCR loan. This is not an FHA loan where you're putting only a 3.5% or 5% down payment. You'll need a substantial amount of money for the down payment. It's going to depend on the lender, but generally speaking, for a single family home, you're going to need at least 20% down payment or 80% LTV, loan to value. Or for multifamily properties, anywhere from 2 to 4 units, you're going to need to give them a 25% down payment, and that's obviously a 75% loan to value. So how does a lender determine whether or not they should approve the property for a DSCR loan? Well, they base it on the DSCR, and the DSCR, Debt Service Coverage Ratio, is basically the net operating income divided by the expenses of the property. Now, the expenses of the property include the PITIA, and this is principal, interest, taxes, insurance, and association fees if applicable. That's usually only for condos and townhouses. The lender does not care about maintenance, does not care about repairs, and does not care about vacancy. Now, this is really great because especially in this market with higher interest rates, it is almost impossible, at least around here, to find a long-term investment property that still cash flows when you take into account potential and future maintenance and repairs and vacancy. These are all criteria that we use when we're underwriting as real estate investors for sure, and you always should. But the lender itself does not take those into account. So if you take the net operating income and divide it by the expenses or the debt that needs to be serviced on the property, that gives you the ratio that the lender goes by and decides whether or not they should give you the loan. So let's say a property has a $2,000 a month net operating income and a $2,000 per month debt that needs to be serviced. That would give you a ratio, a DSCR ratio of 1. Now, back when credit was very loose and the interest rates were very low, there were some lenders actually offering DSCR loans with a 1.0 ratio. But now that credit has tightened substantially, you're looking more at about a 1.2 ratio, which would mean that if your expenses on a property per month is $2,000, using our previous example, the property will need to give about $2,400 a month in net operating income. Now, if the property is already occupied with leases in place, the lender will want to see those leases and they will base that ratio off of the income that it's currently bringing in. But what if the property's vacant? Well, if the property's vacant, the lender will send an appraiser and the appraiser will tell the bank how much they think the property can rent for in that market, and they'll also let the lender know how much it could resell for in that market. Because of this, if you're going to use a DSCR loan on a rental property, I would always recommend getting the property vacant, because a vacant property, you're always going to be able to go in, add value, and get more rent from a new tenant than someone who's been there 5 years ago, whose lease may be 5 years old and they're paying 5-year-old rental prices. So the pros of a DSCR loan are very obvious. You don't need a W-2, you don't need a tax return, you don't need any proof of income at all. And because there's no proof of income required, it also makes it very easy for the lender to underwrite. So you should be able to close on this loan within 30 days or so. In addition, a DSCR loan is actually bought through an LLC, not your personal name. It's always a good idea to buy a property with an LLC, but more specifically, when you buy the property with a DSCR loan and an LLC, it will not go on your personal credit. That way you don't have to worry about your own personal debt to income ratio next time you go apply for your next loan, whether that's for your house or a car or another rental property. Also, there are no restrictions, zero restrictions at all in regards to how many properties you could obtain using this DSCR loan product. With a conventional loan, like a regular 30-year fix, you're generally limited to having only about 10 properties with a conventional loan, and then you cannot get it in your name anymore. With this DSCR loan, there's no limit. So because of that, and because of the fact that the property's not showing up on your personal credit, this makes it very easy to scale your real estate investment portfolio. But the DSCR loan is not perfect, and because of the fact that you don't need to show any proof of income, there are some trade-offs. And the number one trade-off is that because of all of this, you're going to have to pay a slightly higher interest rate on a DSCR loan than when compared to a standard 30-year mortgage. The rate will obviously depend on the lender and your credit score, among other things, but in my estimation, it seems like it's always at least a point higher, 1 percentage point higher than your standard 30-year fix. Now, that could fluctuate, so don't take my word for it. Listen to your lender and shop around a little bit to get the best rate. Also, in many instances, you're actually required to pay a specific amount of points on the loan. So keep that in mind, and like I said, ask as many questions as possible to your lender or your broker. And don't be afraid of a broker as well, because I know people are afraid of brokers in any situation a lot of the time because you don't want to pay a commission that you may not have to pay. But if you go to a direct lender, you're really only dealing with their requirements. If you go to a broker, they're shopping it around to maybe 10 different lenders that offer a DSCR loan. So don't be afraid to talk to multiple brokers and multiple lenders and get the best possible program for you and the property that you're trying to buy. And don't be afraid if it says that you have to pay an origination fee to the broker. It may pay for itself if you're getting a much better rate or much better terms. So should you use a DSCR loan on your next real estate investment? Well, all in all, a DSCR loan is a tremendous tool in order to build wealth in real estate and scale pretty quickly without having to show any proof of income. That makes it perfect for self-employed and entrepreneurs like myself who need financing on properties but may not show the income every year that the lender's looking for. But generally speaking, if you have a job yourself or you have a significant other who has a job with a W-2 and a pay stub, you may want to reconsider getting the DSCR loan and stick to your standard conventional financing. And the reason for that is very simply the interest rate. Because as you may or probably already know, especially when it comes to long-term rental investing, even just like a 0.5 percentage point higher on your interest rate can eat up all of your monthly cash flow and turn a good deal into a bad one very quickly. That is it for today, guys. Thank you so much for watching. Let me know in the comment section down below what you think about the DSCR loan. And if you have any questions as well, drop a comment and I'll help in any way that I possibly can. It gets crazy down there sometimes, so please feel free, drop a comment whether you like this video or dislike this video, and I will respond to every single one of you. Other than that, I appreciate you tuning in, and I will see you next time.